Okay, so in this example 73b, it's a sale of inventory as that is then used as a depreciable asset. So to eliminate the full effect, we're going to reverse first of all the profit on the sale of the inventory, and then secondly adjust the depreciation so that it's in line with the cost of the asset on a group level. And then of course, if we affect the balance of an asset or a liability item, the deferred tax implication on that. As with the other adjusting entries, you always have to consider in which financial period it took place, whether it's the current year or whether it happened in prior years, in which case we also have to adjust our retained earnings opening balance. But this example is a transaction in the current year. I've made here a summary of the entries that will be passed in this instance. It's maybe worth your while to prepare summaries of the entries that we pass for different scenarios, for example, sale of inventory, sale of an asset, because the entry stays the same, it's just the value that's adjusted to the information in the question. Okay, so let's first of all reverse the profit on the sale of inventory. So we know that the unrealized profit was $7,000. In the subsidiaries account, we've included sales revenue of $62,000, which was the selling price. From a group perspective, that sales transaction never occurred, so we reduce our sales revenue with the $62,000. The piece of inventory cost them $55,000 to manufacture, so that is what if in the subsidiaries account they would have recorded the transaction as credit inventory debit cost of sales with the 55. So we want to reverse that entry, so we credit our cost of sales, and then our it's now lying on the machinery line item or property, plant and equipment, whatever account they've used to record the asset in the parent company. That asset is valued now at an amount of $62,000 in the underlying accounting record, but from a group perspective, the asset cost the group $55,000. So we have to reduce the value included in the asset account. So here we see that an asset carrying amount is adjusted, so therefore there will be a deferred tax effect on that of 2,100. Credit our income tax expense 2,100. Okay, so as I've mentioned, from a group perspective, there weren't any sale of inventory and purchase of machinery or property or plant and equipment. From a group perspective, there were just a reclassification of inventory to machinery at the same value or cost that it was included in inventory. So from a group perspective, depreciation should have been calculated on $55,000 at 20% for half a year. So from a group perspective, the depreciation expense for the year should be $55,500. Okay, so that's for the group. In the parent company, they would have calculated depreciation on $62,000 because that's the value that they've included the asset in their accounting records. So at 20% for half a year, would be 6,200. So that's the depreciation expense that is flowing through when combining the parent results with the subsidiary results. But that's not the cost or the expense for depreciation that we want in the consolidated financial statement. So we need an adjustment to adjust the combined results to 5,500. So we need to reduce depreciation by $700. So that's the second leg of the entry, is to adjust the depreciation on the asset. So we need to reduce depreciation. So we're going to credit our depreciation. So debit accumulated depreciation, $700. Credit our depreciation, $700, and the deferred tax effect, reversing the deferred tax asset, is debit income tax expense, 210, and credit our deferred tax asset, 210. Okay. So as you can see, this is almost a combination between a inventory transaction, transfer inventory with in the group, as well as transferring a depreciable asset. So it's a combination of those two that we've covered in previous slides. We've got the reversal of the sale of inventory going against our sales revenue and cost of sales, and then we've got the treatment of the depreciable asset with adjusting the value of the asset item. So we don't have to reclassify this as inventory on a group level. The group recognizes the fact that it's now treated as machinery. It's just the value at which that asset is included at, which is different from the group perspective than that of the individual company. And because it's now machinery, the depreciation adjustment that is required and the depreciation expense needs to be reduced, because on a group level the machinery or the PPE item has less in a value than what is the case in the individual accounting records.